Being able to maintain control over your thoughts and emotions is essential for being a successful trader. So, let's get started with the three most common psychological faults that traders make, and we'll provide you with some guidance if you find yourself in any of these situations. One of the most often seen psychological trading blunders, trading on the basis of apprehension over missing out. For those unfamiliar with the term, FOMO stands for fear of missing out, and the former trader is typically upbeat about each and every trade because, quote unquote, this trade could be the one, right? Something about this trade looks so much better than all the others. So, it has to be the one. If I miss this trade, there may not be an opportunity like this one for a while. We can all agree that sounds ridiculous. Let's speak about the psychology of trading, shall we? In the event that a specific transaction turns out to be a disaster, the temptation to raise your position size is great, because in the event that it is a bust, why not swing for the fences and make some major money on the trade instead? But what happens if the transaction turns out to be a dud, and, despite your increased position size, the deal still ends up being a loss maker? That this might be a significant problem is obvious. Recently, Charlie Munger, Warren Buffett's business partner, talked at an investment conference about how the company lost out on Google and Amazon because they had a blind spot and didn't see the possibility. Specifically, Charlie Munger said that we will continue to mourn them, but that our secret is that we do not miss them all at the same time. Consider for a minute that the world's richest and most powerful successful investors aren't concerned about losing out on every investment opportunity. So why should you be concerned? You simply have to realize that missing trades is a part of the game and that it will happen. So, if you're struggling with the fear of missing out, here's what we recommend to help you. Stay away from chat rooms and trade on your own for a week or two. And if you follow other traders on social media, refrain from using it as much as possible. Exera, since a comprehensive plan is necessary. While developing your own trading strategy, it is not a good idea to rely only on the trade ideas of others while making decisions. Mistake number 2 in psychological training is vengeance trading. In a day or two, these are the traders who can blow up the entire trading account and lose all of their money after taking a loss prevention course. Now, this may work once or twice, but if you keep this up, you'll get crossed that and it's going to hurt. The market doesn't care about you or your money. 2011 to 2019, Investopedia Incorporated, all rights reserved. If you're having this problem where losses are upsetting you so much that you're seeking revenge on the market, you're likely to be a person who is prone to impulsive behavior. The solution to this one is actually fairly simple. And our advice to anyone who struggles with this is to simply get a grip on it before it really ends up hurting you in the long run. To succeed in trading, you must have more winning trades than losing ones. As Drake said, you win some, you lose some. But the important thing is that the outcome is the income. If you trade out of rage or revenge, you will not make any money. If you're still having problems and you're sure your position sizing is in order, then you should consult a financial advisor. Mistake number 3. In the psychology of trading, the gambler's fallacy is a common misconception about probability that lead to poor trading decisions and, in some cases, compounding losses. This misconception extends beyond the trading world and, as you might expect from its name, is most commonly associated with gamblers. We certainly don't want to fall victim to this misconception. In that case, you've fallen prey to the gambler's fallacy, and I must explain the anticipated result of a wager of 10. Phillips has 5 heads and 5 tails, as expected. The chance of the following coin flip doesn't alter if you roll 5 heads in a row, as we've already discussed. After 5 heads in a row, what is the likelihood that the 6th coin flip will fall on? It's still a 50-50 chance. If a sequence of occurrences somehow influences another, then the gambler's fallacy relates to this belief that a coin knows that it recently fell on 5 heads in a row, therefore now should land on tails in this case. There are many examples of the gambler's fallacy, such as someone who frequently travels and believes that they are somehow working toward a crash, despite the fact that each flight is unrelated to the last people at the casino who saw the roulette wheel land on red 10 times in a row, and now they start betting on black even though the previous events have no bearing on what the next band will be. Finally, it applies to traditional music as well, which has a propensity to be unpredictably unexpected. It makes little difference whether you have lost money in 5 consecutive transactions if you raise the size of your position because you feel that your fortune will turn around shortly. The market is completely oblivious to and unconcerned with whether or not your last transaction was profitable. First and foremost, if you want to avoid falling prey to the gambler's fallacy, you must understand that it exists and then take actions to avoid being a victim of its consequences. An extended losing streak does not necessarily portend a successful next transaction, and an extended winning streak does not always portend a successful subsequent transaction. The stock market is not a place for those who are easily agitated, so be sure your greatest adversary doesn't take up residence in your head. If you like this video, please click on the like and subscribe buttons below, and be sure to check out our 3 free video series. Thank you.